Hey everyone, welcome back to the Noob Selling Options channel. I am absolutely thrilled to have you here for another explainer today. We've got a really fascinating disconnect in the market to tear into. We're going to be looking closely at SoFi, and specifically we're comparing the underlying, actual mathematical value of the company against its current and, let's be honest, kind of chaotic market price.
Now, to everyone in the Noob Selling Options community, you already know exactly how we operate. We don't chase the hype, and we for sure do not sell at the bottom just because of a scary headline, right? Our goal is always to separate the noise from the numbers. We are going to look right past all this recent market panic to find concrete, mathematically sound, and actionable opportunities. And really, that brings us to the million-dollar question of the week. Why on earth did a fundamentally record-breaking earnings report from SoFi trigger a 10 to 12% drop in the stock price? I mean, that is a massive, massive disconnect between SoFi's actual first-quarter fundamentals and Wall Street's immediate knee-jerk reaction. So let's figure out why.
Okay, let's quickly run through our playbook for today. We're covering 1. SoFi earnings, the real story. 2. The Peter Lynch PEG ratio. 3. 5-year growth at 20%. 4. 3-year growth at 24.5%. And finally, number 5, the Fortress options trade. All right, let's jump right into section 1. SoFi earnings, the real story.
Look at this baseline. It's just absolutely rock solid. I mean, SoFi completely crushed their revenue, pulling in a record $1.1 billion versus the expected $1.05 billion. They hit earnings per share exactly on the nose at 12 cents. And on top of that, they added over 1 million new members in just one single quarter. That brings their total up to a staggering 14.7 million. Oh, and by the way, this marked their 10th consecutive quarter of profitability. Guys, these are simply not the numbers of a failing company.
So, what gives, right? Where is all this panic actually coming from? Well, let's peek under the hood at the specific segments. Their core lending segment generated $629 million, which is up an incredible 53% year over year. Financial services grew 41% to $429 million. But, and here's the catch, the technology platform segment brought in only $75 million. They took a hit there due to the loss of a major customer. So the crucial takeaway here is that while the core lending and financial engines are absolutely booming, that 10% stock tip was almost entirely driven by a hyper-focused panic over one singular, isolated weakness in their tech platform.
Moving right along to section 2, the Peter Lynch PEG ratio. Now, just to make sure all our fellow noobs are on the exact same page, let's define our terms really quick. The legendary Peter Lynch popularized the PEG ratio, which stands for price to earnings to growth. It's basically a cheat code to find true growth at a reasonable price. Lynch's core rule is super simple. A PEG ratio under 1.0 means the stock is undervalued. It's a bargain. Exactly 1.0 means it's fairly valued. And anything over 1.0, that means it's overvalued. This right here, this is where it gets super interesting. It brilliantly shows how your time horizon changes literally everything. So based on the stock price hovering around $16, if you use trailing numbers, which is the classic approach, the PEG sits at 1.57. That looks overvalued. But if you look at near-term hypergrowth for this year, it plummets to an incredibly undervalued 0.50. However, the most balanced modern approach is to use the long-term forward estimate. If you focus on the next 3 to 5 years of expected 24.5% growth, the PEG ratio sits right at a perfectly reasonable 1.10. That tells us the market is actually pricing SoFi's long-term trajectory fairly accurately right now. Okay, section 3, 5-year growth at 20%. Let's dive into the compounding math. We're starting at year 0 with today's trailing earnings per share of 42 cents. If we apply a strict, conservative 20% compounding growth rate year over year, you can see the progression right here. 50 cents in year 1, 60 cents in year 2, continuing steadily. By the time we hit year 5, that steady 20% growth methodically pushes SoFi's earnings power to $1.05 per share.
So what does that actually mean for the stock price? Well, Peter Lynch says a fairly valued company has a PE ratio exactly equal to its growth rate. Since we used a 20% growth rate, our fair PE multiple is exactly 20. When we multiply that year 5 earnings power of $1.05 by a multiple of 20, we get a strict, mathematically sound fair value price of exactly $21 in 5 years.
Let's kick it up a notch with section 4, 3-year growth at 24.5%.
This time around, we're not looking in the rearview mirror. We're using Wall Street's forward EPS estimate of 60 cents as our starting year 0 baseline. If we compound that forward estimate by 24.5% annually, the growth is pretty staggering. Year 1 hits 75 cents, Year 2 is 93 cents, and by Year 3, earnings reach an impressive $1.16 per share.
Because this model naturally adapts the valuation multiple to perfectly match that growth rate, our new fair PE ratio is 24.5. Multiply that by our Year 3 earnings of $1.16, and our 3-year fair value target balloons to a really exciting $28.42. The math clearly shows a ton of healthy upside from current levels if SoFi secures this trajectory. And finally, the main event, Section 5, the Fortress Options Trade. All right, let's break down the exact mechanics of this beast. You are taking a position by shorting 12 contracts of the SoFi March 19th, 2027 $15 puts. Yes, this does require securing $18,000 in capital, but the true power here? You are collecting roughly $3,744 in premium today. By taking in that massive premium upfront, you are artificially dragging your true actual cost basis all the way down to a break-even of just $11.88 per share. And this, my friends, is exactly why we call it a fortress. Look at this setup. On the left, you have the current stock price fluctuating around $16.23. On the right, your mathematically engineered cost basis is way down at $11.88. That gap is an immediate, built-in 26% margin of safety. I mean, the market would literally have to completely capitulate on SoFi's growth narrative for you to lose capital at expiration. It is a highly strategic, incredibly defensive position against all this short-term macro noise.
So why is this literally the ultimate play for our community? Well, at that $11.88 break-even, you are securing deep undervaluation based on every single Peter Lynch metric we just ran. Plus, this is in complete alignment with the wheel strategy. Think about it. If the stock dips and you actually get assigned those shares, you now hold a fundamentally profitable hypergrowth asset at deep value prices. That gives you massive ammunition for selling future covered calls. And because the expiration date is way out in March 2027, time is entirely on your side to just patiently ride out this current short-term market panic. If you're finding this breakdown valuable, and, if you love turning market panic into actual mathematical advantages just like we do, please make sure to hit that like button on this explainer and subscribe to the Noob Selling Options channel. We're going to keep building that premium and finding these awesome fortress setups together. I want to leave you all with one final thought today. Just keep this in the back of your mind as you're watching the charts this week. Are you letting Wall Street's short-term noise distract you from long-term mathematical value? When fear takes over the market and all the headlines are just screaming sell, what are you going to do? Will you join the panic, or will you use the math to build a fortress? The choice is entirely yours. Happy trading, everyone.